In the heart of China's bustling cities, coffee culture was brewing at a remarkable speed. By the time the world caught on to the coffee wave, a newcomer had already made a splash. Luckin Coffee, a brand that aimed to rival Starbucks with its tech-savvy approach and aggressive marketing, seemed to be on the fast track to success. But little did investors know, the company was concocting not just lattes, but also an elaborate scheme to fabricate its sales figures. What started as a promising venture quickly spiraled into one of the largest financial frauds in Chinese corporate history, leaving behind a trail of losses and shattered trust. Founded in 2018, Luckin Coffee emerged with an audacious goal to surpass Starbucks in China. The company aimed to create a brand experience that was not just about coffee, but tech innovation. Within months, it had debuted over 2,000 locations, offering coffee at half the price of its competitors. The secret to its rapid expansion lay in an app that promised convenience. Users could order online, skip the line, and pick up their drinks without ever stepping inside its coffee shops. This blend of technology and aggressive pricing attracted a wave of investors, drawn by the promise of unprecedented growth in the edible beverage sector. By May 2019, Luckin Coffee's stock debuted on the Nasdaq, valued at $450 million. The initial public offering, or IPO, was widely regarded as a major success, but underlying the company's meteoric rise were allegations and concerns about the sustainability of its numbers. Despite a frenzy of popularity and expansion, whispers began to circulate about the integrity of its sales and the foundations upon which this corporate titan was built. Luckin was gaining attention, but not all of it was good. Luckin Coffee's strategy was simple yet aggressive: discount its products to gain market share and inflate its perceived success. Until then, the approach had been paying off. The company reported total revenues of over $80 million in 2019, but conflicting reports began to emerge. Some analysts noticed discrepancies between the company's advertised sales and the actual financial performance of its stores. Skeptics alleged that Luckin had fabricated data to boost investor excitement, but the company's leadership stood firm, present elaborately crafted growth narratives to the public. Then came the 2020 financial report, a bombshell that shattered the illusion of success. On April 2020, the company announced that it would be investigating claims of misconduct in its financial reporting. The findings revealed an overwhelming amount of fabricated transactions, allegedly totaling as much as $310 million. This revelation was a devastating blow, resulting in Luckin's stock plummeting, losing nearly 97% of its market value within weeks, erasing vast sums of wealth overnight. So, how did this scandal unfold? Luckin's scheme revolved around a deceptive accounting tactic, often referred to as channel stuffing. Essentially, this means that companies inflate their sales figures by shipping more products to their distributors than they can actually sell. In Luckin's case, the coffee chain claimed that third-party partners purchased massive amounts of coffee and other products with the knowledge that these partners would later return the goods. With this practice, Luckin could announce ever-increasing sales figures while still managing to cook the books. By the end of 2019, analysts estimate Luckin's reported sales were nearly $200 million higher than the company's actual earnings. But it didn't stop there. Luckin Coffee leveraged partnerships with various brands and delivery services. They would announce collaborations with food delivery apps like Meituan and Ella.me, boosting consumer perception of higher sales, which was not entirely unfounded as delivery services pointed to significant transactions. Luckin would claim their customers were flooding their stores, creating a buzz that drew more investment into the young brand. Yet behind closed doors lay a different story, one of manipulation and deceit that ultimately obscured the true performance of the company. In fact, the power of Luckin's marketing machine turned the narratives into self-fulfilling prophecies, generating excitement and growing investments from investors enticed by unreal growth numbers. As the company presented itself as a major player in the coffee market, its executives hailed that it would reach break-even within the next year. However, as financial experts delved deeper, cracks started to emerge in the company's growth narrative. Investigative reports began to circulate within financial circles, raising flags about the legitimacy of these exuberant transactions. The downfall of Luckin Coffee began when a series of anonymous tips alerted the public to its dubious finances. A series of reports surfaced regarding suspicious transactions, and by January 2020, a major investor, a hedge fund called Muddy Waters, began doing its own digging. On January 31st, Muddy Waters publicly accused Luckin of engaging in fraud, claiming the company was fabricating hundreds of millions in sales. This accusation set off alarm bells for regulators and investors alike. Soon after, the company announced its internal investigation. However, the damage was already underway. When the findings were officially released in April, it confirmed the worst fears of shareholders. Luckin Coffee had indeed fabricated more than $300 million in sales and transactions. Rapidly, the National Securities Regulatory Commission in China launched an investigation, and the United States Securities and Exchange Commission followed suit. The company faced intense scrutiny as it became clear that the scheme not only exaggerated sales figures, but also misled investors about its profitability and market positioning. By May 2020, the fallout became increasingly severe. The Nasdaq stock market began the process of delisting Luckin's shares, which culminated in official delisting just a few weeks later. Executives faced intense scrutiny, and the company announced that it had appointed a new CEO and CFO in an effort to rebuild trust. However, the damage was extensive, and the future of Luckin Coffee seemed bleak. As a result of the scandal, Luckin found itself in an unforgiving environment. In December 2020, the company agreed to pay a fine of $28 million to the U.S. Securities and Exchange Commission in connection with the violations. In total, the penalties stemming from the fraud reached over $400 million in settlements across multiple lawsuits. While the fine may have appeared to be a slap on the wrist compared to their previous growth, it sent ripples through the coffee industry, serving as a cautionary tale for other businesses embracing the allure of rapid growth at any cost. In the aftermath of the scandal, the fate of Luckin Coffee remained unclear. With the company rebuilding its shattered reputation and restructuring its corporate governance, the public weighed whether it could regain the trust required to resonate with consumers and investors alike. The reality was that fraud rarely sleeps well. In this case, Luckin Coffee's ambition had blinded it to the consequences of its actions. By the end of 2021, Luckin managed a comeback thanks to a strategic shift involving a renewed marketing campaign. Despite the challenges, the company began reinventing itself under a closer eye, realigning to a more sustainable business model. Restaurants and cafes around the world watched closely, intrigued by whether this coffee chain, which had soared to striking heights and then plummeted to irrelevance, would rebound or serve as a reminder of reckless ambition. Ultimately, the Luckin Coffee saga represents a critical lesson for both investors and companies alike. While the allure of rapid growth is intoxicating, unchecked ambition can put entire corporations at risk. In a world driven by numbers and illusions, one question lingers: when does growth turn into deception? For Luckin Coffee, the cost was steep in trust, reputation, and over $1 billion in market capitalization lost. The ensuing years will determine if resilience can indeed brew new life from the ashes of a financial scandal, or if it serves as a stark reminder of a costly mistake. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking: Alan Stanford and the $7 billion fraud. You will not want to miss it. I will see you there.